We got earnings this week from both Eaton and Caterpillar. The difference between the two was, though, that Eaton lowered their guidance and Caterpillar raised theirs when Eaton makes the stuff that goes into Caterpillar's products. So what's the disconnect?
Well, Eaton makes a lot of different products that go into a lot of different end markets. So number one, I would say that Eaton actually, expectations were very low. That's number one. Number two, they actually did much better in North America electrical, and that was driven by res and non-res construction. Not only were revenues better in this segment, margins were better, and they raised guidance in this division. Number three, they lowered guidance overall and their end market growth expectations for the year because of the global macro concerns. So I think they set the bar pretty low. You've got the Cooper acquisition down the road, and I think people are saying, wow, they did so good in North America electrical, and now they're doubling down on North America electrical because that's what Cooper is. So that story, I think, very much is playing itself out, and again, very low expectations with a 3.6% dividend yield. Cat, good quarter, beat, certainly, but they didn't lower the expectations. They didn't set the bar low enough, and they do have issues in China specifically with regards to inventory, and they're working that through, but I think that's going to take some time. I think investors think as a result of that, maybe their numbers aren't low enough for the full year, so I think that's why the stock has actually sold off.
And now Eaton, they are, as you mentioned, acquiring Cooper Industries. They did very well in the residential, as you mentioned, too. What is the company going to look like after that? What percentage of their revenue is going to come from the electrical and from North America?
Yeah, I think it'll probably be something like around 60% North America electrical. So they are very well positioned. And Cooper, by the way, reported this week as well. And they reported a pretty good number, much better than expected on margin side. So this company, Cooper, is such a great little gem. And it's such a good combination because Sandy Cutler, the CEO of Eaton, is a wonderful CEO. And he's excellent at making acquisitions. And so this is what the company does. This is by far one of the biggest that they've ever done. So it is transformational. But it's one of the reasons why we've held on to this position. It has underperformed year to date, but I do think it starts to play catch up relative to its peers and also relative to the market.
So which stock do you prefer? You own Eaton, obviously, so.
We like Eaton because we like that special situations with Cooper, but Caterpillar at 80 I think is quite interesting. I just think you have some time. If you're going to kind of push me on what other names to own in the industrials, I would say Cummins here in the low 80s as well. I think the bad news is out and the risk reward is attractive, and you still have a very strong replacement cycle story in trucks. You've just seen a pause. I believe it really is just a pause. And I also like GE. That quarter was actually very good with organic growth in their industrial business in double digits and also operating profit growth. So I think they're making some progress there as well. So those are the names I would be focusing on.